Thanks to Ram Rating and Ms. Julie Ng as well for inviting the economists to be part of this series. Let me share my screen and get ahead with the presentation. I assume everybody can see that. That is the title of my presentation, The World in 2023, Darkening Economic Clouds Amidst Prevailing Megatrends. Let me sort of give you a preview of what I'm going to talk about, the answers up front, if you will. There's no doubt, when I talk to people like all of you who are on the screen today, on the Zoom call, the world is going through a challenging time economically. The growth is tepid in the US, inflation is very high. We are struggling through an energy crisis in Europe. So that's another big driver of global growth. China, which usually comes in and rescues the rest of the world, is also going through a much more difficult time at the moment. And on top of that, we are still sort of in the recovery phase, if you will, not completely out of it post-pandemic. And then there is the war in Ukraine, which is pushing through a lot of the supply side shocks and inflation. So no doubt about it, we have challenging times right now and in 2023. There are some bright spots and some opportunities, so I want to talk about that. Luckily for us, we sit in a region where some of those bright spots are. And also, there are some trends that are sort of 5 years or decade-long types trends that we should consider. And these can be both risks and opportunities. So that is what my presentation will be. I will quickly take you a macro and regional outlook and then look at Asia and then look at some of those trends that I talked about. So I'll spend some time on this slide because this is essentially what a lot of our analysts and myself, what we're thinking about in terms of the underlying trends that are driving the global economy. So the first one on your left, localized supply chains. We are in that world, or very far away rather, from that world where there was an ever longer supply chain chasing that delta that would give you a discount, right? Now, both firms, private firms, and national governments are looking to shorten their supply chains, build resilience into their supply networks, and really ensure that they have a good supply because of the supply side shocks that we've had over the past few years. So that's the world that we are in right now. Commodity security. Commodity prices are elevated. There are very good reasons for that. That is passing through inflation into the rest of the economy. And we do think that commodity prices, although they will soften a little bit, will remain elevated for the next 5 years. And I'll tell you why in just a second. The other trend here is the green transition. So on the back of COP27, what we see is a divergence in the green transition between the short term and the long term. And the immediate economic situation is really driving the short term divergence and sort of putting the brakes on the green transition. And then 04 and 05, weaponization of business and tech getting geopolitical, you could probably combine those two. But, firms, especially because of the US-China rivalry, but also because of sort of bilateral strains in relationships in different countries, have come under fire. And regulatory pressure from governments or allies of governments have caused firms to sort of change their business models and look to different things in terms of their key business areas. Tech getting geopolitical, we've seen that with the CHIPS Act in the US, we've seen that with the Inflation Reduction Act, onshoring of a lot of green technology. That's of course related to the first trend of localized supply chains. And then number 6, that world that we were in, that we were so used to of low interest rates, low inflation, is definitely over. Capital is very costly now. And you really have to be conscious of the types of risks that you're taking. And so this is our slide on global growth this year. Global growth will come in at about 2.7% this year. We've revised that down from 3.9%. We initially thought it would be a pretty decent year. Of course, March came around and Russia's invasion of Ukraine happened, and that changed things immensely. How do you read this slide right here is all of those different hexagons are essentially different countries. So you can see North America on your left, Europe on the sort of middle on the top. And then as we come towards the right of your screen, you'll see countries in Southeast Asia and North Asia. And then the color, so if it's a sort of dark blue to a light blue, it's lower growth. And if it gets more hot, so sort of the yellows and the oranges and the reds, that is higher growth. So looking at growth now, we've downgraded US growth to about 1.5% this year. You can see US on the left-hand side there in a very tepid kind of blue color. The Eurozone essentially has been at a standstill for the last 4 or 5 months, down from 4% which is what we predicted at the beginning of the year. Of course, Russia and Ukraine, big contractions, but also contractions in Germany, Italy, and Turkey. And we expect recessions there if they already haven't had technical recessions. In Southeast Asia, there's some good news, right? So you can see Malaysia at a pretty good color there in that yellow, Vietnam in red, India, Indonesia, all doing pretty well. Some of that is off the back of a commodity story. Some of that is off the back of China plus one strategies. Vietnam's a good example of that. But one thing to note in North Asia especially is China, right? So if you see China there at 3.3% this year, China has never been that color in the last 20 years, and really a big effect on the global economy. So what I'm going to do now is I'm going to flip between screens. So this new slide is our growth for 2023. And I'll just flip a couple of times so that you can see how the colors change. Right, so the main takeaway is that, as you can see towards the left-hand side of your screen, the colors start to get a lot more of that dark blue color. We are expecting full year recessions, so not just technical recessions in Europe and the Eurozone, in countries like Germany, in Italy, in Austria. The inflation in the US, although we think it will peak and will come down from around Q1, the end of Q1 onwards, still inflation high, meaning that US growth will be rather tepid next year. And then if you go to Southeast Asia, you can see that it's not such a bad picture there comparing the countries. So a lot of the reds have disappeared, but still many countries growing around the 4 to 5% range, with Vietnam still doing pretty well in the region. But growth falling to 1.5% next year, historically, global growth is around 2 to sort of 2.5%. So that is quite a low. And this chart here is essentially the same numbers as the chart that we had before, but I wanted to compare the regions so you get a bit of an idea of the regional comparison. So the way to read this chart is the bar charts. The blue bar is 2022 growth, the light blue is 2023, and the yellow or orange is 2024. And then those boxes on top is how much we've changed our forecast since the war in Ukraine. So as you can see on the left-hand side there, world growth coming down next year, and then in 2024 going to a level that it reached in this year. North America, pretty much the same story. In the Eurozone, negative 0.4% growth next year across the Eurozone. And then there is a bit of a bounce back, but not by much in 2024. So the Eurozone will have 2 challenging years. And then APAC, as you can see there, very high growth and very consistent as well, right? So growth of around sort of 3.5 to 4% across those next 3 years. And very consistent. Now, sort of good growth stories in MENA and Sub-Saharan Africa, a lot of that is the commodity story. But of course, those regions do not add as much to the global economy as APAC or North America or the Eurozone. So this is our commodity story, and what I've chosen is a mix of 2 different types of commodities. So hard commodities on your left, industrial raw materials, soft commodities, food, feedstuff, and beverages on your right. And the way to read these 2 charts is to look at the lines. Of course, we start in 2019, and that black dot, which is the baseline, is essentially around where we are now in Q4 of 2022. So that's the baseline. So as you can see, if you look at industrial raw materials on your left, as we went into COVID, prices plunged, and then they raised significantly because of supply side shocks. They've started to come down, but the war in Ukraine has, of course, affected a lot of that. And although they have started to come down from their highs, you can see that going into 2023 and 2024, they remain elevated. For FFB on your right, those things, those materials tend to react a bit faster because they are essentially dependent on harvest cycles. So you plant these things in the ground, they take sort of 4 to 8 months to come out. So there's a bit more variability as you can change the geography of where you plant them. But again, if you look at the story, it's very similar, right? So a bit of a spike. Now they're coming down. Soft commodities will come down more than hard commodities, so by about 20 to 5%, but will still remain elevated from their 2019 levels. The question, of course, is why do we at the EIU think it will remain elevated? And our reason is that central to our core forecast of all the GDP numbers now and prices of commodities is that we expect the war in Ukraine to last for another 5 years. We expect that the war will look like how it's looked like for the last 10 months, with each side making some incursions and some gains and then sort of pulling back. And then sort of, Russia retaliating by knocking out key infrastructure, which makes it more difficult for the Ukraine to rebuild their economy and also rebuild their war efforts. So that is our core forecast. Of course, war is a very difficult thing to predict. We have different scenarios around how the war might end. But right now, our core scenario is that the war in Ukraine will last for another 5 years, and that is keeping commodity prices elevated. So that's the global kind of picture at the moment with some of the main drivers. What's going on in Asia, in China, North Asia, and ASEAN, that's what I'll discuss next. So looking at China, the way to read this chart on the left is the bubbles that you see on top are economic growth. So 3.3% this year, and then 4.7% next year. And then the bar charts are essentially the composition of GDP, right? So whether it's private consumption or government consumption or investments. And so China, there's of course a long-term and a short-term story. I'll start with the long-term one, which is that China is undergoing a secular shift in the composition of its economy. It's been trying to push for this dual circulation model where it relies less on exports and more on private consumption, with limited success. Although as the economy gets bigger and more mature, of course, those years where we get 7, 8, 9% growth in China are no longer there. China has slowed down because its economy has essentially matured. So that's what we think growth will be over the next 8 years, going at around 4.7% to 3.9%, and then slowing towards the end of the decade. What's the short-term position though? China has had a very difficult year from an economic standpoint. Zero COVID has been driving quite a lot of that, and I'll speak more about that on the next slide. But there have been other factors as well, right? So there's been a power crunch as well because of droughts, which has limited industrial production at some points in time. There's also been, of course, a much talked about property sector crisis. Now, a few weeks ago, probably a week ago, China, after the Party Congress, came up with a 16-point plan to deal with that. We do think while it's not completely a rescue, it will stabilize the market. We won't get those huge property companies that we have in China in the past. Property companies will probably be more local or province-based and not be nationwide type of companies. But we do think that this plan will stabilize the property market, and that's a good thing for China's economy. In any case, the addition to GDP that the property market specifically was adding was probably towards the end of its run as well. And then another thing that has been affecting the economy in China is youth unemployment, which has been pretty high at around 17% this year. And that's because a lot of graduates are coming onto the job market. Between last year and this year, about 20% more graduates added to the job market, so a huge figure. And because of the Cybersecurity Administration's kind of crackdown on certain sectors like edutech and technology, which we've seen over the last 18 months, those were essentially sectors that absorbed a lot of graduates. And so their ability to do so has somewhat diminished. And so that's the kind of the long and short-term picture in China. Of course, I do want to talk about zero COVID. And the reason for that is, right now our central prediction is that zero COVID will not be eased until the middle of next year. And I think our view of that has been burnished after the party congress. But it's very important to figure out why we want to look at COVID. And essentially, when we look at periods where there have been lockdowns in cities versus more open environments, and where we compare cities that have been in lockdown or provinces that have been in lockdown to provinces that have been more open, you can see that the growth potential either snapbacks very fast when they open, or there's a sort of a wide gap in terms of the contribution to GDP. Also, zero COVID costs the Chinese government, provincial governments, around $1 billion a month just to do all the testing and the restrictions and things like that. So not only is it expensive, it also saps growth, right? And so what are we looking for? And I think sitting in Malaysia, sitting in the region, we all know what COVID easing looks like, right? The first point that we were in sort of the middle of 2019 is that COVID is really, really bad. Everybody stay at home. Then everybody gets vaccinated, and then the government starts to ease restrictions, and then we live with the virus endemically. We've been through it. In China, that rhetoric is not there. And so there are two things to watch for in terms of Chinese zero COVID policy in terms of indicators. One, which is very important, is the rhetoric. So when the government starts to change what it's telling its population about COVID. So that's something to watch. And then the other thing, which is a more objective indicator, is vaccination stockpiles. So if vaccination stockpiles start to increase, that will be a good indicator that zero COVID policy will probably be eased. And I'm talking both about traditional vaccines and possibly mRNA vaccines that China is testing at the moment. So those are the two things to look at. Our central forecast is easing in the middle of 2023, but we do see sort of a 10% chance that it will be kind of chaotically unwound during Chinese New Year. So something to watch out for as well. Now, quickly into North Asia, looking at the economies of Japan and South Korea. You will be more familiar with these charts now. The square boxes on top are GDP growth over the next 8 years. And then the bar charts are the components of GDP growth. Again, Japan, long and short term. In the short term, essentially, when we looked at the Tankan survey for Q3, both large manufacturers and smaller SMEs just look at the overall economic environment in the US and in Europe, and their optimism has sort of just been sapped, optimism that they had in the beginning of the year. And of course, the yen under a tremendous amount of pressure, almost a 26-year low there. When the yen does take a hit, because so many Japanese companies produce things abroad, there's usually some sort of mitigating effect, but with the sheer depreciation of the yen, obviously that's not happening at this point. So some big immediate pressures for the Japanese economy. In the long term, one thing that we usually talk about is demographics. But what I want to focus on now is the politics of demographics. At the last election in Japan, 55% of people turned out to vote, but only 35% of youth turned out to vote. And so you get into this cycle where policy, especially economic policy in Japan, should be or could be more youth focused, but because they are not at the ballot, they are not the focus of the political parties there. So something to think about, of course, in the long term, not only on the GDP and demographic figures that we know, but also on the sort of politics of aging in Japan. In South Korea actually had a pretty decent year in 2021 and 2022. During that COVID period, there was a lot of demand for products and services that South Korea produces, all those electronics, those TVs, those screens, both high end and sort of middle end. And so pretty good year for South Korea. This year, as you can see, 2.6%. Growth does fall a little bit next year. That's primarily because its markets of the US and Europe will have much more softening demand. And so we think it'll be a bit more of a challenging year for South Korea next year. What's good about South Korea is that, as you can see from those sort of darker blue components of the bar chart, private consumption is a stable and big contributor to the economy in South Korea. Of course, inflation has had a dampening effect on that, and we'll see that somewhat next year. But we do think that the central bank in South Korea has gotten a hold of inflation. It's about 5.5 to 6%. We do think that that is a peak in terms of their core inflation, and that it will start coming down next year. So as you can see in 2024, sort of returning to more trend growth in South Korea. Now, very quickly now, I wanted to look at a chart of a regional summary for ASEAN. We think growth overall for the region will come in at 5.1% this year and 4.2% in 2023. I've got the chart, economic growth chart in local currency units for the 6 biggest economies. So as you can see, the black dots in Q1 of 2019, so that's all the way on the left of your chart. Obviously, growth dips during the pandemic. And then, the story to take away here is that in general, all of these big economies in Southeast Asia have been growing. And you can see that from the Philippines to Vietnam to Singapore and Malaysia, they've all reached a stage now, or should reach a stage in 2023, where they're about 10 to sort of 20% bigger than they were in 2019. Now, the exception to that is Thailand. As you can see, Thailand only around the end of this year, the beginning of next, kind of coming back to its baseline level, its 2019 level, according to this chart. And that's for 2 reasons. One is it's very dependent on tourism, and that hasn't come back in full swing yet, full capacity, although it's almost there. It took a bit longer in Thailand. And then also more competition for its traditional exports, like automotive and some of the other manufacturing that it does. So that is the story in ASEAN. And then, of course, looking at interest rates globally, what's going on with the Fed, this is another story that I wanted to tell. So here is the currency stories for ASEAN. I've also added the Japanese yen there in that yellow color, and then the Aussie dollar there in that dark blue. But essentially, as the beginning of this year, as the Fed started really hiking interest rates, I don't think anybody on this call will be surprised. You can see the big plunge in the currency, so the depreciation. I've put the baseline at Q4 of 2022. The rate of depreciation really depended on how fast central banks acted. So you can see, for example, the Indonesian central bank acted pretty fast, so their rate of depreciation was slower compared to, say, the central bank in Australia. But the story here is that as we go towards next year and 2024, you can see these currencies generally either stabilizing or recovering against the dollar. Of course, the interest rates is a big reason for that. We do think that the pace of interest rates rises will come to a peak in the US sometime in the first quarter of next year, and that's driving a lot of these currency appreciation. And then also, from a longer term perspective, of course, usually when interest rates spike in the US, you get tremendous capital outflows in the region. We've seen that over the last 20 years. We don't think that there's a risk of contagion this time around. Balance sheets, forex reserves are just much more healthy, and also central banks, I think, a lot more attuned to how they have to react, and have done a pretty good job in reacting to both inflation and the US Fed. So also selectively using at some points their forex reserves to sort of bolster their currency. So pretty good currency story in Southeast Asia over the last year. Perhaps, I would say a bit surprised about the stability of the Indonesian rupiah, especially, but a recovery as we go into the next 2 years. Then Southeast Asia, I've put the graphs here that you should be fairly familiar with now. So let's deal with both economics and politics in these three countries. I could have chosen a whole bunch of others, but we can leave some of that for questions. But I have Singapore here. As you can see, a bit of a spike in 2022 and then returning to pretty much trend. Politics in Singapore, the most boring, I would say, in Southeast Asia. Very good visibility on who the next leader is probably going to be, the Prime Minister. And so we also have, a lot of policy stability. We kind of know what the business environment and policies will be in Singapore over the next 8 years. In Malaysia, of course, dealing with GDP first, a good bounce back this year. We think it'll come in at around 6% this year. A bit under strain next year, but then sort of recovering to the 4% level, which is a decent clip for Malaysia as we go on to the rest of the decade. You all will know that the election in Malaysia has produced sort of a hung parliament. We are expecting a decision from the Sultan soon, and there are potential effects of that. I don't think many people predicted the outcome of the election. There could have been several reasons for that. In general, though, at the EIU, our view is that over the next forecast period, because it's a coalition government, there will be no sort of clear majority in parliament. I think that's very clear. The other thing that we suspect and our view is that policy making actually will be pretty good. So the environment for policy making since 2018, when Pakatan came into power, there have been quite a lot of evidence of joint bills being produced across the aisle by different parties. They've had to sort of come together and work to produce these bills. A lot of these bills have been sort of socially progressive bills, anti-smoking, voting rights, party hopping, things like that. Not all of them, of course, passed into law, but it shows that there has been a decent contribution and spirit of policy making across the aisle. And our sense is that that will continue. In Thailand, of course, I talked about the economy just before on the GDP chart, so I'll focus on the politics for this slide. By March of next year, Parliament will have to be dissolved, and by May of next year, there will need to be an election that will be held. That's written into the constitution. We don't think that the current Prime Minister will back down. He probably will not run again for Prime Minister. There's a term limit reason to that, but there's also a popularity reason to that. His kind of band of followers and generals sort of past their due date. We do expect big gains for the opposition party, especially Thaksin's daughter, and other opposition parties as well. It's quite interesting to see that. We haven't completely yet seen, because they haven't been in total campaigning mode, what their policies are going to be. So something to watch. There are some opposition parties that are a lot more digital focused and want to focus on the digital economy, and there are others that are more focused on sort of urban rural transfers. So definitely something to watch out for in Thailand. But as you can see, we do think that growth will be relatively tepid in Thailand over the next 8 years. And so now, zooming out from the region of Southeast Asia and Asia, just looking at some themes to watch out for and how that will affect the region and countries in the region. So all of the numbers that I've told you before, all of those GDP figures and the commodity prices are our central forecast. And of course, we have risks to those, right? Usually there are upside risks and downside risks. But I'm sure as Kai-Jack will also tell you, a lot of our risks now are more towards the downside. So I've put 10 of them up here. These are top 10 in terms of their impact, not necessarily their likelihood. But looking at the top there in blue, cold winter worsens Europe's energy crisis. Right now, you have a very united Europe. There's a lot of solidarity between the countries as they face off against Russia, as they go through their energy crisis. If the winter is remarkably cold, that will drive up costs. That might even lead to some deindustrialization as power becomes an issue. The question is, will that affect Europe's unity and solidarity in terms of where they get their energy from, or will they kind of break from the pack and make separate deals with Russia? That could, of course, affect sort of the long-term view on the energy crisis in Europe as well. China's zero COVID, we are really, really watching this one. I've told you those two indicators to look out for in terms of the narrative and stockpiles of vaccines. But if China keeps its zero COVID policy for a bit longer, that could lead to a severe recession in China. And of course, that would have add-on and knock-on effects in the region. Conflict erupts between China and Taiwan. That's outside of our core scenario. We don't think that that will happen in the next 5 years. But with congressional visits that will continue, with Nancy Pelosi's visits that happened a couple of months ago, activity and military activity in the straits between China and also with the US has just increased. And that means that the possibility of an accidental, clash or something happening between the two militaries will happen. We don't think it will be deliberate, but that could have an effect on shipping routes, for example, that could temporarily block some of the Taiwan Straits. So that's something that we look out for. We do work with clients to look at what are the potential effects of US sanctions on China, just as you would have as a business to have looked at the effect of Russian sanctions at the beginning of this year. It's sort of a good thought exercise to see what would happen in that event. Now, of course, there have been some trade wars between the US and China, and so there are already some products that are blocked from a trade perspective. So there's actually some evidence to look at those types of things. So these are our top 10 risks that could put more downward pressure on our central forecast. Then the US-China rivalry, could that derail the Asian century, right? On this map, what I have here is the alignment of countries. So you can see the blue and the blue stripes are US aligned or US leaning. The red stripes and red is China leaning, and then neutral or unclear is in gray. And so Malaysia and Indonesia take a lot of pains to stay neutral and have done a good job. There are two things. One is that I think the bigger economies in Southeast Asia, Malaysia, Indonesia, Thailand, have all been able to balance this ambiguous environment, diplomatic and military environments between the US and China. Of course, Southeast Asia and ASEAN is a theater of competition, and the smaller economies, the Laoses and the Cambodias, have not been able to sort of balance that and have more likely leaned and chosen aside. But if you look at, say, Thailand, which is a US aligned, a US treaty ally, in fact, they in the last 3 months have had military exercises with China. And if you look at Indonesia, who takes a lot of pains to stay neutral, they have also had military exercises with the US and its allies as well. So that tells you a little bit about how these countries are able to balance both. We don't think that in our forecast period of the next 5 years, any of these countries will be made to choose. We do think that they have the kind of diplomatic and economic heft to sort of balance between these two countries. Of course, as the US-China rivalry increases and there is more competition, especially in certain industries, like the tech industry, there is some benefits from that for Southeast Asia, right? We've seen some of the China +1 or China +2 strategies that have benefited Indonesia and Malaysia, Vietnam especially, over the last few years. That's not only a US-China rivalry aspect, that's also just a supply chain issue type of deal as well. And in southern China, ASEAN does have quite a lot of similarity in terms of its manufacturing base, right? So in terms of automotives or in terms of sort of light manufacturing, electronics, it can do a lot of the work that is being done in China. But also southern China is very good at certain things that ASEAN is not, right? Chemicals is a big example there. So ASEAN by no means a trouble-free trade zone. but we do think it will generally be able to do well from this US-China rivalry in terms of extracting from both of these countries. And then transition policies to face security, energy security headwinds. So I talked a little bit about this, about the green transition and how it's diverging between the short and the long term. The energy transition, the shift towards renewables has been going at a pretty good pace for the last few years. That has come to a bit of a halt. The brakes have been put onto it because of the energy crisis in Europe, right? So Europe generally has to get energy wherever it can, at whatever cost and whatever color it is, just because of the situation that it's in now. So that's one reason that the brakes are on. But also these higher commodity prices, inputs that go into solar and wind capacity generation, those are also higher. And then if you look at the multilateral institutions and both private and public funding that would normally go towards the green transition, some of that has also been put on hold, not only because of the more challenging economic environments, but with these multilateral institutions also kind of looking to help countries that are going through more difficult economic times in the short term, right? So financing kind of for the energy transition with a short-term break. Coming out of COP27, of course, some level of disappointment there in terms of carbon emissions and targets that were set there. Some reasons for optimism in terms of financing. So we can, discuss that. But what we do see is that in the medium and longer term, a big push towards renewables. And the reason for that is that, in addition to costs of production falling and costs of input falling generally before the recent spike, there is now a geopolitical discount on renewable energy. Generally, renewable energy doesn't travel across borders, right? You build those things in your country and you consume it in your country. Of course, there are exceptions to that, but because you don't have to rely on a pipeline or some kind of LNG gas pipeline, the geopolitical discount is higher, and so we think that will be an added push to the green transition in the medium term. Another trend is the metaverse, right? We've seen so much investment, so much hype in the metaverse. Is there going to be a reality check next year? So there are two things, right? One is big tech and doubling down on VR and AR headsets next year. We saw a lot of headsets sold in 2021, 11 million. A lot of that came from Meta. Apple is releasing a headset next year. Sony is going to release an updated one. Meta is going to release a more expensive one, because VR and AR headsets very important for the metaverse, right? And then this whole concept of the metaverse, this three-dimensional, interoperable, immersive, global spanning video game. Will that really happen? Meta, of course, has spent 27 billion since 2021. Other companies like Microsoft and Nvidia want to release their own version, and video companies have been in it for a long time, right? But what are the signals to look for? And that's why we asked the question, what the MSF, right? So the MSF is in Silicon Valley. That's the Metaverse Standards Forum. And it's a set of policies and guidelines essentially to ensure that you can move seamlessly from Meta's version of the metaverse to Microsoft or whoever you have a version of the metaverse. So it looks at community guidelines, trust and safety policies, privacy, data interoperability issues, and they have been sort of talking in terms of the forum. Most of the big tech companies in Silicon Valley are there and at the table. But if those policies kind of take shape and start to form, that's a very good indicator that we'll have much more thrust into the metaverse next year. So certainly something to look at. And then revenge tourism. Next year, spending on tourism will come back to its 2019 level. There's a very big caveat to this, and I was having a debate with Julie before this. International tourism up 60% this year, and up a further 30% next year. So it'll come back to about 1.6 billion arrivals. In 2018, that was 1.8 billion arrivals. So, in terms of arrivals, it's still 200 million short of 2019, but, approaching kind of that pre-pandemic level. Receipts, so tourism expenditure will rebound a lot faster. Receipts will actually reach their 2019 level, but the big caveat there is that, that $1.4 trillion, which will match 2019, is really a lot of that contribution is by inflation, right? So that's the reason that receipts will come back to 2019 levels, but tourism numbers not quite there. Another big reason, of course, to watch China and zero COVID, because who's off the tourism market is the Chinese tourists. Last year, about 55 million of them traveled. In 2019, it was around 160 million, so about 100 million Chinese tourists who spend an average of $200. I was just having that conversation with Julie before this. They are off the market. So another big reason to look at tourism. And then I want to end on this slide. A lot of people, of course, talk about talent. There's been a lot of layoffs in the tech sector that have dominated the news. But I wanted to shift the discussion to something that's a bit longer in terms of our outlook and our trend. So I've put two charts here that are about a decade spanning. The first one on the top is the labor pool in the big economies in ASEAN. And you can sort of ignore the Singapore number because Singapore's so highly dependent. Of course, all countries to some extent are dependent on foreign labor, but Singapore much more so than the rest, so it bounces up and down. But as you can see, the labor pool in the other 5 big ASEAN economies really kind of shrinking, right? So working age population coming down by around, just below 2% to close to 0%. That the trend is that the labor pool is growing slower, with the exception again of Thailand, which has been contracting essentially. And then on the bottom is average real wages across the same time frame. So you can see, of course, post-pandemic, it comes into the trend where you see wage growth kind of at fairly constant levels. And we think that is, really driven by the labor pool growing slower. So definitely something to think about in terms of contribution to inflation and things like that. But these two trends are interacting with each other. And with that, I will stop sharing my slides and hand it back to Li Ming. Thanks very much.
Thank you, Li Ming. So a very good morning to all. So as mentioned, I'll be covering the nation economy outlook for next year. So as you may have noticed, I've named the title for my presentation today, Should We Be Worried? Next, please. So generally, I feel that there is this worry or fear that the global economy is heading into another major downturn, and also as briefly also shared by Sumana earlier. So much so that I think if you look into refer to the Google Trends data, which quantifies the search interest globally. So the global searches for the term recession have actually been reaching a new high in recent months, and currently is about 4 to 5 times more compared to where we were at the beginning of the year. So naturally, I think it's also probably why all of you are here today. So just to get a better sense of where the economy is actually heading and how Malaysia is actually doing in general. Next. So to assess where Malaysia is actually heading, I'll just start off by laying out the current domestic economic landscape. Then we'll look into some of the challenges and risks faced and how it actually matters into Malaysia's 2023 outlook. And then I'll just end with the key takeaway and summary of forecast, RAM's forecast for Malaysia. Next. So let's start by keeping stock of where Malaysia currently stands. Malaysia has enjoyed a fairly robust recovery this year. So if you look into the first 3 quarters in terms of GDP growth, we have actually managed to chart quite a respectable 9.3% growth. And much of the acceleration is actually largely driven by the reopening of the economy, which is also accompanied by the rapid recovery in terms of private sector activity as well. So as you can see from the chart, the double-digit growth in the private consumption and private investment numbers are sort of a good sign in terms of where Malaysia is actually performing and how rosy it is in terms of the recovery and economic health for Malaysia. So you can see that the economic players are more open to spending, households and businesses in general, and also more willing to invest and expand their productive capacity. So we generally expect growth to remain sustained in the fourth quarter of this year, and our current estimate is for it to actually come in at around 5.1% in the fourth quarter. For the full year, we are projecting a growth of 8.2% for 2022, which is a relatively healthy rebound over the 3.1% registered for 2021. Next. So as mentioned, the full reopening of the economy sector have actually played a major role in the current recovery momentum. For one, the reopening of the economy has actually allowed a steady and healthy recovery of the labor market. So unemployment rate, you can see that have already improved to 3.6% in September from the 4.2% at the start of the year. So the higher level of unemployment, as also shown in the red line on the left-hand side chart, which shows the proportion of working age population employment as a proportion to working age population. So generally, we do see the number of people that are actually currently employed has already surpassed 2019's level. So generally, we are seeing a lot more people being employed and being in the labor force. So this brought along a generally wider and broader consumption base, along with also an improvement in household income, which again, in turn also gave a sustained means for spending among the Malaysian population, which is quite a stark contrast to where we were 2 years ago at the start of the pandemic. Besides investments, particularly FDI has also seen a relatively healthy recovery as the economy recovers and reopens. So much of the return of FDI is actually concentrated in the manufacturing as well as the services sector. So that alone, the general return in terms of investment sentiment bodes well for the overall economic potential over the longer run for Malaysia. Next. So overall, I think while some might argue that the strong growth for 2022 is a large part due to low base effects, to a certain extent that is true because we have been experiencing subpar growth over the last 2 years. However, I would say that the underlying economic expansion is still there and we are also making meaningful growth. So compared against 2019, Malaysia's GDP for the first 3 quarters this year is about 5.4% larger compared to where we were back in 2019 over the same period, which is the first 3 quarters of the year. So this is actually very close to the long-term steady-state growth of around 5 to 5.2%. So this indicates that the economy has actually managed to churn in a healthy expansion in 2022. However, I think on the flip side, it's also not something to be exactly happy about because what we are actually doing is that we are essentially still missing out on 2 years worth of development. Because we are only 5.4% higher than 2019's level. So in a way, it will still take some time for us to actually converge back to the pre-pandemic trend. Another thing to note is that I think while the headline number is also strong, the recovery so far have been relatively uneven and concentrated in a few sectors. So maybe just briefly, I'll just describe how do you read this relatively busy graphic. So the figures actually denotes, again, what's the percentage difference in terms of the GDP or GVA number in the first 3 quarters of this year, which is 2022, and how it actually compares to the same period in 2019 before COVID-19 pandemic actually hit. So on the left and right side, which there is the supply side as well as the demand side component. I've color coded it such that if it's more on the orangey reddish color, it denotes that actually that sector or that particular component remains below pre-pandemic level. And conversely, if it's blue, that means it's already recovered from the pandemic and is above 2019's level. So one of the obvious and biggest winner here is actually the manufacturing sector, which is strong growth can be primarily attributed to the E&E demand upcycle over the last 2 years. So growth-wise or expansion-wise, manufacturing is actually close to 15% higher than where it was back in 2019. So this sort of indicates that the sector has not really lost too much momentum due to the pandemic. In terms of laggards, I think the key laggards are the mining, construction, as well as the agriculture sector. So construction and agriculture in particular is actually marked by the labor shortage issues, which actually limits its economic potential. So a lot of the ongoing construction work couldn't really be done, and the same could be said for agriculture. A lot of the harvesting also couldn't be done very efficiently. So production-wise, it hasn't been really performing as well as compared to, say, the manufacturing sector. Next. So moving on to the risks and challenges. So looking ahead of the key challenges faced by the economy, one of it is actually the higher cost, which actually affects broadly both households and businesses. So for households, consumer price inflation has been climbing since the start of the year, and this is in large part driven by the notable rise in food prices, which I think most of the audience will already be feeling at the moment. So with the food component constituting around 30% of the overall spending of a typical household, so it will definitely be more prominently felt by consumers in general. And if you go down the income bracket, it will be even more so felt among the B40 households, where I think food in general also constitute an even larger proportion of their daily spending. So if inflation does not actually cool down moving into 2023, this could have some implication for consumption spending next year. Yeah. The same could be said for businesses as well, where we also observe an increasingly businesses being increasingly challenged by the rise in cost of doing business. So this is also captured by our quarterly RAM Business Confidence Index, or BCI for short. So in case you're wondering what is this RAM BCI is all about, so very briefly, the BCI is a comprehensive survey conducted by RAM on a forward-looking business sentiment, as well as some of the topical issues faced by the small and medium businesses community in Malaysia. So one of the topics that we actually periodically survey is the challenges faced by businesses, just to get a better sense and a more timely view of what is on the ground feel among the businesses. So as you can see from the right-hand side chart, the most recent survey indicates that the rising cost continues to top the list of challenges faced for the third consecutive quarter. So you can see that where about 8 in every 10 firms surveyed have actually said that they are actually facing significant challenge on that front. So definitely it is one of the top of the list in terms of the key challenges and headwinds faced by businesses. Next. So consistent with the prevailing challenges faced by businesses in general, we can see that these pressures are also weighing on their sentiment and near-term prospects. So if I start off with the left-hand side chart, you can see that we have plotted the PMI, or the Purchasing Managers Index, for the manufacturing sector. So the indicator generally suggests that the manufacturing sector momentum has softened quite substantially in the last 2 months. So this would suggest that the sector is likely to also be heading towards a slower pace moving ahead. Another indicator for us to actually gauge the near-term outlook is also our very own RAM Business Confidence Index survey, which another thing that we track is also the 3-month forward-looking business sentiment, where we survey their 3-month outlook across 5 main business aspects. So what I plotted here on the right-hand side chart is the overall index for the RAM BCI. So it actually fell for the second consecutive quarter to 46.2 points, which is below the neutral point of 50 in our fourth quarter survey, from the 51.4 points in the third quarter survey. So the decline in sentiment again was in large part due to businesses being more pessimistic about their performance outlook. So firms in general are expecting their revenue and profitability outlook to revenue and profitability in general to actually fall in the next 3 months. However, if I had to point out the positive observation, is that I think firms surveyed generally are still sticking with their capital investment plans, and they have shown no intention to actually reduce or cut down their headcounts in the next 3 months. So generally, I think firms might still be expecting to still keep that existing capacity to actually maybe weather through some of the future challenges. Yeah. Next. So as covered by Sumana earlier, I think global growth is definitely expected to slow next year. So we generally expect that to also have a direct effect on Malaysia as through weaker export demand. So one of the factor weighing on growth is the continued tightening in terms of monetary conditions, particularly in the US, where the US Fed have actually been very aggressively raising its key policy rate this year. So generally, we are expecting a slower global demand, and this would directly especially hit our export-oriented manufacturing industries, and one of the major exporting sectors for Malaysia is the E&E sector, which makes up around 30 to 40% of our overall industrial production output in general. So we are also seeing that slowdown, not just from the general slowdown in overall demand, that there's also been some evidence of an impending deceleration, as you can see in some of the leading indicators for the sector that we typically track. So in particular, you can see on the right-hand side chart, South Korea and Taiwan, which typically are seen as a leading indicator for the global E&E value chain, have been experiencing consistent downtrend in terms of new orders recently. So the slower orders would mean that I think there is definitely a slight slowdown in demand globally for E&E goods. So this will eventually cascade into slower order books for all the other E&E producing countries along the E&E value chain or E&E supply chain. So in turn, Malaysia being part of the one of the key cogs in terms of the overall global supply chain for E&E, I think Malaysia's producer will likely also face some slowdown moving ahead. Next. Just to cover a bit on the financial market. So I think, as mentioned earlier about the aggressive interest rate hike in the US, it also has implications on the Malaysian financial market. So generally, we are seeing bond yields have actually been rising quite rapidly, quite aggressively since the start of the year. And this is a large part because of the aggressive rate hikes in the US. So however, I think while Malaysia's MGS yields has also been pressured upwards because of the rising US Treasury yields rates. However, the pace in increase in terms of US Treasury yields has been outpacing the MGS yields, which is why you can see that even though Malaysia's yield has also been rising, the yield differential between MGS and US Treasuries has been falling quite substantially, as you can see from the right-hand side chart. So I think as of around November, we are below 100, below around 50 basis points so far. So January is a very narrow spread, I would say, compared to say at the start of the year, which is around 200 basis points. So this actually also led, the narrow yield differential has also led to a dampening in terms of investor demand for domestic assets, and which in turn also leads to more bond outflows, which I'll share in the next slide, as well as the strengthening of the US dollar, or in turn, the weakening of the ringgit. However, I think if you look into the more recent trend, the sell-off have moderated somewhat since the start of the year. If you can look at the right-hand side chart on the very right side of the time frame, you can clearly see that there is actually a notable dip in terms of the dollar ringgit rate. So this is actually largely attributed to the somewhat less hawkish messaging by the US Fed, where while they actually conveyed a message where while interest rate is expected to continue to increase, the hike or the pace of hike will likely come at a slower pace, or in other words, smaller increments. So this generally have moderated some of the fears and some of the sell-off pressures among foreign investors. So this in turn also contributed to some improvement of the ringgit against the dollar exchange rate. Yeah. Next. So looking at the foreign fund flow, so again, I think this also again highlights how the aggressive rate hikes have actually affected Malaysia's financial market. So far this has actually triggered quite a broad foreign fund exit from the regional emerging markets, which includes Malaysia. I think even for Thailand and Indonesia, they have also faced similar forms of foreign fund outflows. So the bond market have seen quite successive months of successive months of foreign fund outflows or weak foreign demand since the start of the year. And barring that 1 month in August. But however, year to date, the bond market have recorded a net foreign outflow of around 7.9 billion ringgit. The same could be said for the equity market as well, which has also garnered somewhat a weak foreign investment appetite in recent months, as you can see on the right-hand side chart. Next. So closer to home, just to touch a bit more on the domestic policy front, Bank Negara have been engaging on their own monetary policy normalization as well. So far, the OPR has risen to around 2.75%, which is a total of 100 basis point increase this year. We are expecting normalization to continue next year to at least reach 3% in 2023, and 3% being the pre-pandemic level. So a large part of the normalization move is actually due to the strengthening economic activity as well as the improving labor market conditions. So I think as shared earlier, the labor force participation and employment conditions in general have actually already reached pre-pandemic level. So that gives comfort for Bank Negara to actually continue to normalize its monetary policy rate. Next. So coming back to Malaysia's growth prospects, generally we still expect Malaysia to continue to still expand next year. So as covered in my earlier slide, so riding on the strong growth momentum that we actually saw in the first 3 quarters this year, we should have enough tailwind to actually ensure continued growth and recovery for the rest of this year as moving into next year as well. As you can see from the left-hand side chart as well, where I compare the 5-year pre-pandemic GDP trend, we can see that so far, the actual GDP have yet to reach where we should have been had the COVID-19 pandemic not happened. So there is still a bit of that recovery story for Malaysia going into next year. Investment in FDI also been quite encouraging, as also suggested here on the right-hand side chart by Midas foreign investment approval data. So this builds up to the general economic potential and output capacity prospects for Malaysia moving ahead. So, and I think this is especially critical given the loss in progress as well as the underinvestments over the last years due to the pandemic. So a rebound is definitely much welcome in terms of further boosting Malaysia's economic potential. Next year, we could also see some additional support from the further recovery of the tourism sector as well. So I think as shared by Sumana about the revenge travel earlier, I think air travel or international travel has definitely been on an uptrend. And the same could be said globally. You can see the air travel numbers, as you can see from the left-hand side chart, have actually already surpassed the levels over the last 2 years, although it remains below the pre-pandemic 2019 level. Domestically from Malaysia as well, as of mid-2022 or middle of this year, foreign tourist arrival already recovered to around half of where we were pre-COVID. So this is definitely encouraging as we do see foreign tourists or foreign tourists actually comes into Malaysia once the border reopens. So a large part of the recovery actually is contributed by Singapore and Indonesia, which makes up around 50 to 60% of the overall foreign tourism arrival so far this year. So, and perhaps this should not be too surprising given the close proximity of the two countries to Malaysia. However, I think once international sentiment normalizes further, we should see further upside or maybe more tourism arrival from some other countries as well. And this could further also help to the tourism industry in Malaysia to actually further recover. Another upside is also, I think the wildcard is coming out from China as well. Once China fully reopens its border, this could also further add into the tourism arrival numbers. But however, as Sumana mentioned earlier, it might take a while before we actually see any meaningful return in terms of Chinese tourism, given some of the insistence or some of the policies in terms of their zero COVID guidelines. Yeah. And just to note, Chinese tourists makes up about 10% of Malaysia's tourist arrival pre-COVID. So it's a relatively large source of tourism receipts, except for those, the largest source, I would say, outside of ASEAN countries. Yeah. I think, but one important note on our view is that while we do expect further recovery in 2023, we are not expecting a full recovery, as mentioned earlier about some of the challenges especially coming out from China, while also global growth shows as well as the inflation pressures remaining rather elevated globally. So this could ensure that maybe we should not actually see a full recovery in terms of tourism arrival next year. Yeah. Next. So all in all, some of the key takeaways and forecasts, we generally expect growth to actually remain respectable in 2023, although it will undoubtedly be slower than this year. So our current projection is actually for growth to actually slow to 4 to 5% next year from 8.2% this year. So we feel that Malaysia cannot actually escape the ripple effects from the slower global growth, and in particular, the slowdown in consumer electronic demands will impact the semiconductor sector. However, I think on the flip side, the broad and diversified domestic economy actually provides a steady base for continued growth. So private consumption will continue to be the main anchor in terms of driving Malaysia's economic growth, and there will be further recovery once the labor market also continues to recover. So I think as mentioned earlier, unemployment rate currently is sitting around 3.6%, and we are projecting an average rate for this year at around 3.8%, and we continue to expect unemployment rate to fall further to around 3.5% in 2023. There will also be some upside from the further recovery of some of the laggard sectors, as mentioned earlier, like the agriculture and construction sector, once some of the issues faced by the sector, such as the labor shortages, actually being gradually resolved. Then also maybe the laggard sector in terms of tourism-related sectors as well. So once tourism arrivals recovers, there should also be some upside and further recovery and contribution from these sectors. However, I think overall, the growth prospects or the risk remains tilted very heavily to the downside. I think Sumana has covered quite extensively in terms of the risk for globally. So I think just to briefly mention, I think some of the key risks that we are actually looking out for is the globally would be the geopolitical tensions. If it intensifies, it could provide more downside to our growth forecast, or any severe or significant stagnation or recession scenarios could also impact our forecast on the downside. Domestically, some of the key risks that we are also looking out for is the sharp rise in food prices that could impact consumer sentiment and private consumption momentum. And another one is also any form of prolonged labor shortages. We generally do expect labor shortages to gradually ease over the next few years. Over next year. However, if it continues to remain rather tight or a rather sticky issue, this could also put more downward pressure on the overall economic outlook in general. Next. So I'll just end off with just very briefly what's RAM's key forecast for next year. So generally, I think just to reiterate, we are expecting GDP growth to come in between 4 to 5% this year, next year, sorry. And largely will be domestic demand driven. Private consumption is expected to grow by around 5.8%. While I think on the external side, there will be some external slowdown. So our export forecast at the moment is about 1.5%. Next. So some of our other key forecasts, I think for inflation, we are expecting inflation rate to average around 2.7% next year. And for the dollar ringgit exchange rate as well, given I think the most recent messaging by the Fed have actually shown us some meaningful recovery or some meaningful appreciation of the dollar ringgit against the dollar. So we generally do expect that to somewhat continue next year, and the dollar ringgit exchange rate to average between 4.4 to 4.5%, 4.4 to 4.5 next year. In terms of the fiscal balance and government debt, we are expecting a fiscal deficit of around 5.4% to the GDP and 62.4% to the GDP in terms of the government debt. And I think that should roughly round out our forecast for this year. Yeah, I won't go into all the numbers for now. Yeah. Back to you, Lim.